What is up, everyone, and Happy New Year. This is Colin from More Money Maintenance, welcoming you to the second episode of our everyday investment journey. In this episode, we are going to be reviewing the following. First, why you need to start investing right now. Second, how our 5 portfolios performed in their first week. And third, our market prospects for 2021. For those of you that are new to the series, we're tracking 5 separate portfolios that follow different investment strategies. Each portfolio was started with a $100 initial investment on December 28th and received their first $25 weekly contribution this past Thursday, December 31st. The goal here is to show that it is possible to turn small dollar amounts into big returns. There are a bunch of videos out there that show us what it's like to have $100,000 in a portfolio, or what happens when you contribute thousands of dollars a month, and that's great for those that have the money. But for newer or younger investors, this is often not a relatable story. By following these 5 portfolios, you will get a real-time look at what the ups and downs of investing looks like from a starting point that we can all relate to. Another point that I will emphasize again is that all these portfolios were built with ETFs. Exchange-traded funds are baskets of stocks, bonds, or other investments that can be traded over the stock market and automatically diversify your investment. By using ETFs in your portfolio, you won't have to worry about analyzing companies, reading financial statements, or anticipating microeconomic trends within the business world. I've structured this series in a way that tries to address any mental barriers that you may encounter when trying to start your investment journey. The most important thing to remember is to just get started. Let's look at the portfolio that Warren Buffett recommended to us to demonstrate this point. By looking into a hypothetical investment made 5 years ago into Warren Buffett's recommendation, we see that we have a solid return of around 75%. But what I want to point out is what happened this past March. When the stock market crashed because of the Great Lockdown, as it's now being called, we see our hypothetical investment would have dropped from about a 58% return to an 11% return. Obviously, this type of loss is not pleasant for anyone, but we still stayed in the green. The same can't be said for that same hypothetical investment made 3 years ago into the same portfolio. As you can see here, the 3-year investment dropped to a negative 15% during the March crash. This is real-world evidence to support Warren Buffett's philosophy: time in the market is more important than timing the market. Being that none of us could have predicted the outbreak of COVID-19, but all of us could have bought an index fund 5 years ago, that should be all the evidence that we need to support this claim. Now let's check out how our portfolios did throughout their first week. Our top performer of the week was in fact Warren Buffett's recommendation, bringing in 0.68%, while our worst performer, our dynamic trio, brought in 0.39%. If we jump into the dynamic trio here, we see that everything is still in the green. Even though this portfolio is not up as much as the others are, I really like what we are seeing here. You'll notice that all of these ETFs are total market ETFs. This translates to very broad diversification. For example, our total stock market ETF closed in the green, but not as high as an S&P 500 index fund. This is because an S&P fund houses only the top 500 stocks in the country, which performed well this week, while the total stock market fund houses a broad range of small, mid, and large cap stocks. If you're unfamiliar with those terms, that's just Wall Street speak for small, mid-size, and large companies. In our case this week, this ETF was brought up by large cap stocks but brought down by small and mid cap stocks. The result is a balancing act that still landed us in the green. This is exactly what we want to see because it means that we have broad exposure to all sides of the market. So you might be asking, why do we want exposure to small companies that seemingly weighed us down this week? This is because small cap companies have the most growth potential. See, most small cap companies get hit hard during recessions because they often have a relatively small revenue base, lots of debt, and less brand recognition. Yet this translates to more potential upside as well. You are not going to find many large cap companies who can double their revenue in a given quarter, but this is very possible for small caps. Think of it this way: if you owned a lemonade stand and sold 2 cups of lemonade, you'd double your revenue only by selling 4. But if you were a thriving lemonade business who sold 300 cups of lemonade this quarter, hitting that 600 mark would prove more challenging. So these small caps have a lot of potential upside, especially after a recession, which is why I think it's important to have some skin in the game here. This same point applies for our total international stock fund and our total bond market fund. They take the aggregate of their total respective markets and give us the balanced outcome, leading this to be one of my favorite portfolios for newcomers. So now let's jump into David's portfolio. For those new to the channel, this is a recommendation made by Yale's Chief Investment Officer. We've got a pretty diversified mix here, and this past week is beneficial in demonstrating why diversification is important. As you can see, our 2 bottom performers were U.S. small and mid-cap stocks, while our 2 top performers were international emerging markets and real estate. This is exactly why David recommends diversification. It is hard to predict when segments of the market will do well and when, but by being invested in all of them, you'll catch the ups and downs of each. As long as the markets continue to trend upwards, which they have since they've been in existence, then you'll always come out on top. Another interesting holding in this portfolio is VTIP, which is a short-term inflation-protected securities fund. These are U.S. Treasury securities that hedge against inflation. I am specifically interested in how the fund will be impacted in the upcoming year as a result of the economic recovery from the COVID-19 pandemic. Inflation seems to be on the mind of a lot of investors, as the iShares TIPS bond ETF pulled in about $1.1 billion in capital in recent days. With the amount of unplanned expenses that our country has had this year, inflation should be something that we all watch coming into this new year. If we jump on over to our third place performer, we see that our aggressive growth portfolio performed well, but not good enough to beat the S&P or our dividend portfolio. This is likely because investors were doing some realignment within their portfolios going into 2021. The business dynamic for almost all of 2020 was tech-oriented, with staying at home being the thing to do. Tech companies thrived in this environment, leading to numerous all-time highs. Yet our more traditional companies that are retail or experience-oriented did not see the same recovery. Now, many analysts are speculating that portfolios will start to realign again in the new year, with 2021 bringing us widespread distribution of the COVID vaccine and hopefully a return to normalcy. It is likely that we will see some of that recovery for the more traditional companies. Our performance throughout this past week indicates that these speculations are correct and that investors are expecting some normalcy this upcoming year. This means that it should be a good year for those boring investments such as dividend stocks and S&P 500 funds. Only time will tell, but an early guess may suggest that our Warren Buffett strategy will lead the year if we do in fact return to normalcy. Now let's check out some charts that I made for tracking our performance. This first graph shows us the performance of each of our portfolios against each other. There's not much going on right now due to how early we are in the process, but this chart will be very telling over time. All of our portfolios started here together at a $100 investment. Now, after a week in the market and about a $25 contribution to each, you see that they've started to part ways, but not by much. This is a different look than the charts on M1 Finance because we can see how all the portfolios stack up against each other directly. This second tab is a detailed view of our top performing portfolio of the week. Here we see the comparison of the total amount that we invested into the portfolio compared to what the market value of the portfolio is. This will be another great chart to view over time because it will show us the compounding effect. We want to see our deposits continue to increase linearly and consistently, but we want to see our market value take an exponential path trending upward like this. Now if you look over here, this pie chart is simply showing us the market value of the securities that make up this portfolio. As you can see, Vanguard's S&P 500 fund is worth $113.25, and Schwab's short-term treasury fund is worth $12.49. These are some nice numbers for a portfolio that's only a week old. So all this has been pretty optimistic, but what about the risks that we face in 2021? I'd say that the biggest and most blatant risk is a problem with the rollout of the COVID-19 vaccine. As noted in this Charles Schwab article, November's good news about Phase 3 of the vaccine rollout led to the strongest month for global equities in over 45 years. If the vaccine rollout is not as smooth as the market thinks it will be, we could see a drawback in the markets. I would not be too concerned about this though. If this does happen, it'll give us a great buying opportunity to buy the market at a good price. And I imagine the downturn wouldn't last too long. As the rollout process starts to fix itself, I imagine investors will regain their confidence pretty quickly, driving the markets right back up. Another risk to consider is the political risk with the new administration entering the White House. Anytime there's a change in administration, there are political changes to trade policy, economic policy, tax policy, foreign policy, and corporate oversight, all of which impact the market. We don't know the full extent of how things will change yet, nor do we know if the market will react negatively or positively. So the best approach here is to continue to invest, diversify your holdings, and avoid doomsday talks. There were tons of headlines saying that the world was going to fall into economic turmoil when the Trump administration took over, and obviously that did not turn out to be true. But anyone who pulled out of the markets listening to that advice missed out on record returns for these last 4 years. The same thing can now be said about the Biden administration. Every new president comes with uncertainty. Don't let political speculation deter you from making sound financial decisions. So to summarize the key points of this video, first, you need to start investing now. Time in the market is more important than timing the markets. Second, our portfolios are all performing well, but after 1 week, Warren Buffett's recommended asset allocation is leading the way. Third, don't let potential market risk prevent you from investing, and if anything, take advantage of those market downturns by investing more. If you enjoyed this video, please light up that like button to show your support for the channel. I encourage you to share your investment strategies, questions, or feedback in the comments below so that we all can learn something new. Thank you again, and be sure to check in next week to conduct some more money maintenance.